it's easy to make mistakes when investing. I've been investing for nearly 20 years and I've made a ton of mistakes that make me shake my head and ask the question, how could I be so stupid? But that's life, and like with most things in life, it's not about how many times we fall down, but it's about how many times we pick ourselves up again. If you're new to my channel, my name is Jake. I retired from my 9-to-5 job at the age of 37 and live off of my dividend portfolio and have reached what is called barista fire. So if you're new to the channel, welcome. What 99% of dividend investors get wrong is assuming that the dividend growth rate of an individual stock will continue forever. Now, I'm guilty of this as well. When I first started learning about dividend investing, I assumed that whatever, the historical dividend growth rate of a company was, that was just I just kind of assumed that it would continue on like that. Why wouldn't it, right? What most dividend investors do is they look at the historical chart of a stock, and in this case, the historical dividend growth rate of a single stock, and assume that this growth rate will continue going up at the same rate forever. This whole recency bias thing is a thing. The reality is that this almost never happens. In fact, it's nearly impossible for a company to grow at the same rate forever. The simple reason for this is, well, it's really hard to compound earnings growth as a company gets bigger in size. Now, this is incredibly important to understand. A company cannot grow its dividend if the company cannot grow its earnings per share. The dividend growth of a company comes from the earnings per share growth of the company. Dividends are not magic. They come from the earnings from real businesses. So in order for a company to grow its dividend at a certain rate each year, the company must grow its earnings per share at that rate year in and year out. The challenge is that it's incredibly difficult for a company to grow its earnings per share at the same rate forever. I mean, think about it. It's much easier for a company to grow double digits when they're first starting out. However, once a company gets bigger, it becomes very difficult for the company to grow at the same rate in the future. It's easy to maintain a 30% growth rate in the millions, but once you get into the billions, things become incredibly more complex. There are multiple reasons for this. For example, a company's TAM, or total addressable market, does not grow infinitely. Now, many great companies recognize this and diversify by expanding into new markets to grow their total new addressable market, right? They can expand in other business units, expand globally, internationally. An example of this is, think about Amazon growing from just an online book retail store to dipping its toes into practically every aspect of human life. For every one company that we can name that managed to do the impossible, there are thousands that failed to do the same. It's easy to sit here and say that you're going to just pick the 1 in 1,000 company that can do it. You see it all over the internet, all in the comments section, that people just say, well, just pick the winners, dummy. Well, in the reality that I live in, this is a fool's errand, and I think most people would be better off recognizing they probably aren't going to be able to only pick the winners and focusing their energy on what they can control. And what you can control is focus on an index that holds a basket of stocks that will give you the greatest odds of achieving your dividend growth goals over the long term. Anything can happen over a 1 or 2 year time period. An individual stock can do very well over a short period of time, and also in some cases over a long period of time. Now, with ETFs or index funds, they don't go up in a vertical line either. And the growth rate of companies held in any given index will fluctuate over time. And when this happens, it causes the dividend growth rate of the dividend ETF or index fund to change year over year. But the major difference here when focusing on an index fund versus just an individual stock is that you will experience a heck of a lot fewer gotchas along the way. You will experience less of the boom or bust and more of a consistent growth rate over time as these companies in the index all compete in what we call capitalism to maintain and grow their market share and take more market share, and in doing so, increase their earnings per share. And when that happens, when these companies grow their earnings per share, they represent a larger percentage in the basket, or in this case, the index fund, and these companies held in the fund will grow their dividend. And by doing so, the index fund, which holds them, can pay a higher dividend each year. Now, this is obviously a simplified version of how this works, but you get the gist of it. As companies become more productive, as they gain more market share, they represent more in the index. And as these companies flourish, this is what we call capitalism at its best, they will represent a higher percentage in these index funds versus an individual stock can have good years and bad years. Many stocks actually end up failing. When you look back at the original S&P 500, only 10% of the S&P 500 that existed in 1957 when the index was created as we know it today, only 10% of those companies are still in the index. Change is inevitable. Change happens. Companies get disrupted. ETFs, on the other hand, they hold a basket of stocks and it's a survival of the fittest. If a company does well, they're represented more or higher in the index. Think about NVIDIA. How many ETFs had NVIDIA in the top 10 years ago? I would say probably not very many. Now today, every major ETF that's not focused on some sector or dividend focused screen or filter, something like that, every major index has NVIDIA as one of the top holdings in the index. That is capitalism. That is how the market works. That is how it's set up. And it's very, very difficult to pick the winner and say that you're going to only pick the winner. So to recap, what 99% of dividend investors get wrong is they assume that the dividend growth rate of a company will go up forever when planning their future returns. This is unfortunately not the case. And that is why I love holding dividend ETFs that screen companies for quality metrics based on metrics that are important to me as a dividend investor. Some of my favorite ETFs are like SAHD and DJRO, which screen companies based on dividend history, earnings growth, and other quality metrics. So now I want to walk through a few examples and share some of my opinions and thoughts on this challenge that we as dividend investors have, thinking that dividend growth rates will go up forever. And I want to look at the history of a few different examples. So the first one here is Home Depot. In 2023, Home Depot raised its dividend by 10%. In 2024, Home Depot raised its dividend by 7.7%. And here in 2025, Home Depot raised its dividend 2.2%. Now, when I was investing in a Home Depot years ago, I would look at the historical dividend growth rate of Home Depot, and you'll see here that the 10-year dividend growth rate of Home Depot is over 16%. And I thought to myself, well, 16%, that's okay, great. So I put it into my dividend reinvestment calculator and I just assumed the dividend growth rate of 16%. And it didn't even occur to me the reality that maybe this 16% isn't going to continue forever. Maybe there's going to be some bumps along the way, but it really didn't occur to me when I was first learning about dividend investing that this may not be the reality going forward. And that was the mistake that I made. That thinking this whole recency bias really hit me hard as an investor, especially when I was doing research and looking at, different charts and researching for different, investment strategies. It's very, very difficult to overcome recency bias when you're investing. So when we look at Home Depot and we look at the dividend history, the dividend growth history of Home Depot, you'll notice here that when Home Depot, in the 90s, they were raising their dividend double digits, 20%, 30%, 40% in some cases. Now, it's very different to raise a dividend from 6% to 7%, 7% to 11%. The earnings per share of a company when they're in their 100 millions versus, tens of billions, it's fundamentally different when it comes to compounding, and it's very, very difficult for a company to maintain that level of growth as they gain market share. And a lot of this has to do with the total addressable market of Home Depot. What is their market? How quickly can they grow, and for how long can they maintain those growth rates? But what you'll notice here is over the last decades here with Home Depot, their growth rates have been inconsistent. However, I will say when they've grown their dividend, they've grown it very aggressively and very successfully. You'll notice here during the great financial crisis, they ended up pausing the dividend growth they didn't grow their dividend at all. But since the great financial crisis, up until these last couple of years, they've grown at double digits. So with this, I'm not saying that Home Depot is a bad investment. I mean, the numbers speak for themselves, right? But what I'm saying is, if you're a dividend investor and you're looking at future, projections, you're projecting your future dividend growth, be on the more conservative side and understand that companies can go through rough patches and understand really where the dividend growth is coming from. It's coming from the earnings growth from the business. These are real businesses. Another example is IBM. Now, over the years, IBM has been such an interesting story. People love to hate IBM. They love to love IBM. They've had decades where they've done very well. They've had decades where they've done very poorly. And that's just the interesting thing about a company like IBM, where you'll look here, in the early 2000s, they struggled. But then in 2004 up and until about 2016, they did very well. But since 2017, they've really flatlined, right? They haven't really had any dividend growth. And so if you were investing into IBM in 2013, you're thinking, okay, I'm just going to assume that IBM will grow at a 10%, CAGR year over year. Well, you've been unfortunately very disappointed if you came to that conclusion in 2010. Another one that I want to look at is Chubb Limited. This is an insurance company based out of Switzerland. They've had very good historical dividend growth rates in the past. But if you look in recent history, recent history being the last 10 years, over the last 10 years, they've barely kept up with inflation for most years. And so if you were investing in a Chubb for the last 20 years, your first 10 years looked significantly different than your last 10 years, talking about the last 2 decades. So when you're planning this out, just another example where dividend growth rates can accelerate and they can decline, just out of nowhere. Another example here is Altria Group. This is a tobacco company. This company has incredible history of dividend growth. This is one of the greatest use cases of dividend growth and total returns if you go back since its inception. Altria Group is one of the best performing stocks of all time when you factor in the reinvestment of dividends. But what you'll notice here is the dividend growth has significantly declined over the last couple of years. I started investing into Altria Group in, I think, 2017, 16. And I just kind of assumed by default, I was going to get a 7 or an 8 or 9% dividend growth rate. Well, that has not been the case with Altria Group for the last couple of years. Now, I don't know if this is going to accelerate. All I'm saying is to once again, showing an example of dividend growth rates are not guaranteed. Now, I want to show more of a positive example of a company that has been able to maintain a strong dividend growth rate. Now, Costco over the last 10 years has increased its dividend by over 12% compounded over the last 10 years. And you'll notice here that they have not yet really seen a significant decline in their dividend growth rate. Now, if you're not familiar with Costco, they do every couple of years a special dividend. So that's where you're seeing this 400% increase and then the next year a 76% decrease. But this is because of a special dividend. So you don't want to factor that in when you're considering the dividend growth rate. At least technically you shouldn't do that. But what you'll notice here with Costco is they have maintained consistently for the last, give or so, 20 years, a dividend growth rate over 10%. Even when their revenues, even when they only had a few locations, where now they have hundreds of locations and internationally, they're growing their earnings at a significant rate. And so this is one of those examples where it's kind of like an Amazon, where this is the diamond in the rough, but who knows what if they were to be caught up in a scandal or something were to happen. The whole moral of the story here is these companies, individual stocks, are great until they're not. And when you invest in individual stocks and you assume that their growth rates are going to continue, sometimes they do, but most of the time they don't. And now when you look at some of my favorite dividend ETFs like SCHD, you notice here that the dividend growth rate of SCHD has also been pretty sporadic, right? In 2016, it had a dividend growth rate of just under 10%. 2018, it had just under 7%. And here since 2019, they've done incredibly well. So even with dividend ETFs, it's never a guarantee that you're always going to get double-digit dividend growth rates. Another example here of a dividend ETF that I really like that I hold in my portfolio is DGRO. In fact, they do screen for companies that have increased their dividend for at least 5 years. And you notice here that the dividend growth rate with DGRO has been a little bit more sporadic. And this has to do with how the index is filtered and screened and the companies held in this index. And coming back to the example of Home Depot is one of the top 10 holdings of DGRO, but you notice here this year that Home Depot only increased its dividend by 2.2%. That will impact the dividend growth rate of DGRO because it is held in DGRO, right? So, but you are a little bit insulated by that. Instead of having all of your eggs in one basket with Home Depot or other individual stocks, you're getting a basket of companies in this index and you're getting the result of the companies of that index, right? So some years it'll be up, some years it'll be down. I'm just illustrating here and showing that the ETFs are not immune to the fluctuations of dividend declines, dividend growth increases, all of that good stuff. And then the last example here is VIG. This is the Vanguard Dividend Appreciation Index Fund. And this ETF, I don't hold this in my portfolio. I think it's a fine ETF. I just don't hold it. This ETF screens for companies that have increased their dividend at least 10 years or longer. And you'll notice here, I do like seeing VIG because it's been around for longer than the others. Its inception here since 2006. And you'll see here that the dividend growth rate, even an ETF that screens for dividend growth of at least 10 years, will have sporadic dividend growth. Okay, you'll notice here in 2017-18, it had dividend growth rates of 5 and 6%. In 2022, dividend growth rates of around 12%. Once again, even though you invest in ETFs, you're not immune to the ups and downs of the market, and the dividend growth rates will go up and down. So what 99% of dividend investors, myself included when I first started out, get wrong is they assume that dividend growth rates, whether it be an ETF or an individual stock, will go up forever when planning their future returns. This is unfortunately not the case. In more cases than not, you will see more sporadic dividend growth in individual stocks. And also in ETFs. ETFs are not immune to this. The important thing to understand and to remember as a dividend investor is that dividends are not magic. Dividends come from real businesses providing real value in the world and growing their earnings per share. If a company, a business does not grow its earnings per share, or if an ETF holds a basket of stocks where those basket of companies, stocks, they do not grow their earnings per share, the ETF likewise, the company, the ETF, will not be able to grow its dividend. That is what new dividend investors get wrong. I hope that this video is helpful. I hope that you learned something new, and I'll see everybody in next week's video.